Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focus Compound. If you're watching us on YouTube or listening to us on a podcast app, hit the subscribe button. That will notify you every time we upload a podcast. And of course, if you're interested in our money management services, you could go to focuscompounding.com to get more access to that, or reach out to me directly, Andrew at focusedcompounding.com. So in today's podcast, Jeff, we are going to be first starting with the jobs report. It's been a few weeks since we
hmm
had recorded the podcast, and today is October 4th, and the Fed released their non-farm payrolls, and we added 254,000 jobs last month. This caught a lot of people by surprise. I think a lot of individuals were expecting these numbers to be a little bit softer, especially because the Fed had cut interest rates by 50 basis points and projected being worried for the future and recession risks. And they came in pretty hot. 254,000 jobs were added. Something that is interesting to me is the bond market and what's going on in the bond market. Talk a lot about banks on this podcast. So obviously we have exposure to banks, so we follow the yield curve, follow what's going on in the rate environment. And on this news, rates started to rise. Interestingly, so the Fed cut interest rates like what,
hmm
probably about a month ago now, and we are
Yeah, and rates are
basically
yeah.
flat or maybe a little bit higher
hmm
from where they cut that, at least like the 10-year
hmm
and the 30-year bond. Uh, Interestingly, to think about when they originally cut, rates started to run. So what does that mean? That's the bond market saying they are worried about inflation resurging, right? So that's currently what's going on. So strong jobs report today. Now the narrative changes all the time. But okay, maybe we're not actually going into a recession. One jobs report is probably not indicative of a trend, but want to hear your thoughts on that because it seems to have caught a lot of people off sides. Something that just monitoring price action for so long. There's a lot of geopolitical risk going on right now, especially overseas, and it seems like bonds can't catch a bid to be the flight to quality that they traditionally have been. So I just think the bond market's fascinating right now because it seems like it's just not acting how it has acted over the past handful of years. So want to get your thoughts on that.
Yeah, some people asked because of a previous podcast where we talked about, I think I said that all the rules of thumb were pointing to a recession. And I did mean that literally. But I didn't mean that that means that there will be a recession, just that this time I think most people are expecting there not to be a recession and for that to be in violation of normal rules that they would use to judge whether there'll be a recession. And we talked about that, like inversion and then on inversion of the yield curve. We talked about change in unemployment rate, and then even when we've talked about certain stocks, some of the stocks that have not done as well, depends, are stocks that wouldn't do as well because of fears of a recession or credit contraction or something along those lines. Whereas those that are in the same categories, but not exposed to that kind of stuff, have done better. You mentioned banks. Banks in particular, you can see that if a bank benefits from lower rates, but doesn't have a lot of credit risk, it's done really well this year as a stock. Whereas if it has a lot of credit risk, it hasn't done so well.
What do you think about that when the Fed cuts interest rates short term and then the long term end of the curve starts to rise on that? What does that signal to you? Are we going back to a very steep yield curve environment where banks are going to be able to make hay again, lend out, at much higher rates, and then obviously have their deposits paying short-term rate or smaller amounts, so the curves can be incredibly steep? What does that tell you?
I,
What do you think about that?
I mean, as of this report coming out and everything, it looks like that's kind of the consensus view, I would say, but it's very fast to know that because I think expectations for cuts in the short term were reduced now to being expectations that Fed will cut rates by 25 basis points or something, but that they're basically pricing in less rate cuts, and then they're pricing in more economic growth. So
Mhm.
that's what would happen if that's the case. But expectations have changed a lot throughout the year for when rate cuts would happen and all of that. So I don't know if that will actually be what happens. But yeah, that's the expectation. The expectation isn't for a recession, but it is for them to cut rates. So um, yeah,
Mhm.
pretty steep would be the expectation if you're cutting, if you're still expecting them to cut rates and you're expecting that this kind of jobs report is what you'll see normally and everything. Yeah.
Mhm. Do you ever think the Fed is, maybe doing it also to bring down the interest payments on the debt? Because the amount of debt we have and what, those interest payments would just continue to balloon the, national debt. You ever think they think about that? I mean, they claim they're not political, but do you actually believe that to be true?
Well, I think that they think sometimes about fiscal policy and whether their policy is able to achieve what they want it to because of the importance of fiscal policy. Um, but I don't think that they would think that that's a good idea because being particularly loose could not be a good thing to do. I am not sure that that would be great unless there was also coordinated with fiscal restraint at the same time, you know?
Mhm.
But if you're asking, would they like budget deficits to like would they like a balanced budget and the ability to cut rates more? Probably, but they can't coordinate. I mean, they're an independent part of the government that isn't able to work together on that.
Mhm. Interesting. Well, we will continue to monitor, but lots of interesting things going on in the yield market currently. Want to revisit our old friend, Spirit Airlines. Never a friend in the sense that we actually own the stock, but we have talked about it on the podcast a bit. News came out yesterday after the close that Spirit Airlines was exploring a bankruptcy filing, exploring Chapter 11. So, not a full on liquidation. Chapter 11 would be more of a restructuring of the company. Equity holders typically get wiped out, debt holders get converted over to equity, is usually what happens. Um, Pretty interesting situation, though, right? So, obviously, JetBlue was trying to buy out Spirit Airlines. It was blocked. That merger was blocked. And here we are, what, not even 6 months later?
Hmm.
And Spirit Airlines is now exploring bankruptcy. So, is this
That
an
was their argument
opportunity?
for why they should be allowed to
They
merge,
did say
basically.
that, right? They
Hmm.
did say that we were gonna have to go into bankruptcy. People thought that that was just bankruptcy or, negotiations, talk, trying to gain that leverage on why they should close. And here we are, like I said, not even 6 months later. So I guess if you're first thing, if you're JetBlue, do you say, "Okay, let's try to re-explore this," right? And try to buy him in bankruptcy, or do you not, re-explore because it was blocked? But yeah, wanna get your opinion, your take on what's going on with Spirit Airlines, and we could, of course, pull it up through QuickFS. Gosh, the airline industry just continues to always be a very tough industry for investors to make money. Been proven
Well,
time
I
and
think,
time again.
yeah, I mean, I think it's tough right now for the companies that focus on the lowest fares. Southwest is having trouble. Spirit, like we talked about. Um, but from the government's perspective, this doesn't necessarily matter because if they aren't going to liquidate, you know what I mean. So they blocked a merger of something happening, and then if they're able to prevent that kind of merger from happening, that kind of consolidation, then it doesn't take capacity out in the long run. So it's not like it necessarily increases fares for anybody. So they may, they may get what they want. It's not like their job is to protect companies from going into bankruptcy.
No, but also it does suck if they blocked it and they were saying that they were gonna go into bankruptcy and then that happens.
Hmm.
That's unfortunate.
And it's likely that they'll consolidate in some way with somebody. It's just that it will be somebody where there's less overlap, maybe, and a less advantageous price for the owners of the company, right? For the bondholders in this case, is basically what's left. There's some value in the stock right now in the market, but
Mhm. Who would be a likely takeover if not JetBlue?
Well, Frontier was the one that wanted to merge with them originally, right?
Yeah,
And
it's true.
actually, anyone would be likely if allowed by the government. It's not impossible. Not Southwest, but others would be.
Mm-hmm. Why not Southwest?
They don't have the same planes.
Mm-hmm. Are you following what's going on? Southwest?
Yeah.
Do
I
you have
mean, I
any
fly
opinion on
Southwest
it?
all the time. I probably
I know
will in the
you are
future.
frequent. Yeah, you are. I only
But
fly
it's
American
very convenient
Airlines.
for me, yeah.
Everyone has their thing, right? I only fly American. You only fly Southwest. Yeah.
Yeah, I fly a lot from Dallas to New York, and there's multiple airports in both places, and it's highly competitive, and Southwest offers very frequent flights at low prices. And I also don't travel internationally, and I do travel domestically, so it's very convenient.
Mm-hmm.
Um, and I don't care where I sit, so that's convenient too.
Mm-hmm.
So, um, and they're, historically they have been likely to board on time and leave on time and everything. They turn the planes pretty fast. That, at least the airports that I have been going to, I have been going to some of the busiest airports, which I think is more the problem. But
Mm-hmm. What are the issues with Southwest? You want to give a summary of what's going on with the company and the activist?
y- yeah, so we talked about it a long time ago. Southwest, the gap between Southwest and other airlines closed over time because other airlines became more efficient in what they did, and Southwest became more like the legacy airlines, but it still was doing well. And then you had the problem of all these upcharges and everything, which Southwest doesn't participate in at all. So Southwest advertised fare might not seem that low, but why I say it's pretty low for me is you get, well, first of all, if you pay, I think it's $25 now, it used to be like 15 or something, you basically can pick your seat because you get to board the plane before other people. And it's, self-serve seating. And you get 2 bags, checked bags for free. So basically, there's no reason why anyone would pay more than the advertised fare that you see plus $25 to get everything they need, unless they're flying with more than 2 checked bags per person or something, which is a lot. Whereas other airlines are all these upcharges for everything else. So, I mean, because for business things that we've done, I have flown other airlines, and it's a much more involved process of both checking out and then also boarding the plane because it's separated into groups and there's all sorts of different charges that you have. So the gap between the original fee that you pay for the fare and then what you end up paying is bigger at other airlines. And that's working well because we're in an environment where people want a lot of upgrades and things. So it's worked very well for the other airlines that way.
Mm-hmm.
I mean, I think Southwest would have benefited if there had been a recession faster. I don't think it's an accident that Southwest has underperformed other airlines during a very long period without recession in the industry.
Mm-hmm. And the activist, what's his main gripe with the company?
I don't know what his main gripe is with the company, but I mean, it is underperforming other airlines, and they're going to make the changes that they're going to make other changes. I think to look like other airlines. My guess is Southwest will look like the other airlines at the end of this, but we'll see if that's true.
Mm-hmm. And you think that's going to ruin the customer experience then, it sounds like?
No, I think I'll make it the same as the other airlines, and just will eliminate some choice that people had. It's
Mm-hmm.
interesting because from an antitrust perspective and everything, the Southwest making these changes is a much bigger deal in terms of competition than any of the Spirit stuff. But the government has no ability to set these
Stay
kinds
over
of
that.
policies and stuff. Yeah, it doesn't have. I mean, if you merge and stuff, it has control over that, but it doesn't have control over whether you all choose to price the same way. I mean, it has control over that if you explicitly do it, but airlines are so transparent that they can coordinate whatever they want to do. They can all set their prices the same or whatever without talking to anybody. So it's very easy for them to know what they're doing and to all adopt the same sorts of policies and everything. So, but from a consumer choice perspective, more diversity in the industry in terms of pricing models and stuff is generally what would lead to more innovation in terms of different options that you'd have. And I think we'll have less of that from the both of the things we're talking about. Changes at Southwest will make it look like the other big airlines. Southwest is a huge airline domestically. And then also you have on the real low end with like Spirit, with being a choice of all those add-ons. Spirit, probably 50% of their revenue or something comes from things that aren't the base fare. So you have two completely different airlines that way. One which is all about the base fare, and one which that's a very small part of it. And both of them are changing in some way. So it's making it more commoditized that everyone's going to look like the other big airlines.
Mm-hmm. I felt like a fish out of water the first time I flew Southwest.
Yeah.
It was definitely a different experience. I was like, okay, I'm following the herd right here. Let's look at Southwest Airlines and get your
Mhm.
thoughts on the valuation. 17.7 billion market cap, 12.7 billion enterprise value. Price of sales is zero point 0.7. I think we've looked at airlines in the past couple of years, and at one point weren't they like 0.3 or zero point 0.4 price of sales, but zero point 0.5 EBITDA sales.
Okay.
10-year CAGR revenue 4%, assets 6.6, EV to free cash flow on a TTM basis 14 and a half times. Yeah, what are your thoughts on these levels?
Yeah, I mean, you see the entire chart. You can see from 2000 to today, Southwest hasn't done that amazingly versus other airlines. So, I mean, as a stock, I think it's underperformed the S&P probably, or has not done well for 25 years, and would have been an amazing stock performing from its founding through about 25 years ago. And you have change in the model and change in leadership over time. Um, it's typical of what we see with a lot of these amazing founder-led companies. You know, it's like a
Mm-hmm.
Walmart to me. Same thing. Walmart had a model that was different from everybody's. It worked for a long time, and then eventually, kind of isn't anything special now, and there's no room for them to deploy capital at better rates. Same thing happened to Southwest eventually. But we did do a podcast. I don't remember what we called it, but we went back to looking at what the airline industry looked like, say, in 1995 and everything, and showed
Mm-hmm. The
how
consolidation
you had
and
so
everything.
many new entries. Yeah. I mean, when I was growing up on airlines, you wouldn't there hmm, most of the airlines I flew for the first,
Did you
so I
fly
probably
Trump
flew,
Airlines?
no, but I would have flown let's see. The only major airline that I would have flown that people would know about, and its name has kind of been erased at this point, is Continental, which became United Continental.
Mm-hmm.
Um and uh, that's major, but we're talking about probably twice as many major players at that time. And then most of the other ones were airlines that came in, flew for a few years, and went away. Um, and no one would recognize the names. And some of them would be flights from particular places without coverage in the rest of the country. Um, and there's different reasons for why that might be. We talked about loyalty programs and all of that and the importance of that, but also just, slow down in growth. I mean, when growth in industry is too high in terms of passenger numbers increasing all the time, um, you get new entrants all the time too. So
Mm-hmm.
as you've seen, growth is really a lot lower in the United States. Certainly, Southwest, you can really see it because they focus on domestic U.S. There just hasn't been a huge growth in that industry, and so people don't pile into an industry with 6% growth or 4% growth or something, but they do if it's 20%, and that's also helped. That they're just it's a very mature industry in the United States.
Mm-hmm. It'll be interesting. What do you think will happen with Spirit? Do you think they'll just eventually get purchased? Do you think
Well, I
they'll
don't know.
go
I
through the
mean, this
process? What do you think?
I don't know. It's too detailed for me to know that in terms of there could be possibilities for people to make money and things in debt that we're talking about, because you don't know the exact way that it'll shake out, right? Because it could end up in a way that has some value, therefore a lot more value, depending on if there's some deal of that it's somewhat attractive to people to consolidate stuff, right? I mean, some of these things are attractive to people. I mean, there were two bidders at one time, two different bidders that wanted to offer a lot more money for the company than what it'll end up being. But that's also when we talked about US Steel, right? I mean, there are people who want to pay more for that company, but will they be allowed to? So it's the same sort of thing. Now, Dish and DirecTV is the same sort of situation. So they've been blocked to go to merge, blocked, and then basically sold for like $1. So basically, like a bankruptcy, it's not much different. They're just assuming the debt to merge the two together. But that's a change in the industry where the feeling is okay. Um, Satellite TV is such a small part of the overall options now that it's okay for them to merge. But for a long time, it was blocked on that.
Hmm. Interesting. So we could talk about our topic, and the topic for today is going to be from an email that someone sent in, and it's an investing business model topic. And I don't know if we've ever directly talked about it on the podcast, so I thought it'd be great to chat about it. And uh, this email says it's about scaled economies shared. I've heard scale economies shared. I've heard scaled economics shared. Um, so semantics. But this
Mhm.
concept comes from Nick Sleep
Yeah.
at Nomad, and he owned Costco and Amazon. And I thought this email right here lays it out well, and then we could get your thoughts on it. So the email says, for people listening, my question is concerning the scaled economy shared business model. This is regarded as an excellent business model by some investors. Essentially, if a business benefits from economies of scale, they share those benefits with their customers through lower prices. This enables the business to increase market share, in turn gaining further economies of scale, reducing prices again, and the cycle keeps repeating. It seems this business model inherently traps a business into growing revenue without much profit growth due to constant price reduction. And if the business ever wants to earn higher profits, they will need to increase margins, thereby opening up an opportunity for competition. A business that struggles to increase profit without losing market share doesn't strike me as ideal. I'm curious to hear your thoughts on all this. A few examples of the scale economy shared business model are possibly Costco, Amazon, and maybe Ford around 100 years ago. So just
Mhm.
to put a illustration on that,
Yeah.
did some googling around. I think people listening generally understand it, but Costco, lower prices, better value prop, increased scale and efficiency, which gives them lower cost per dollar of revenue, which gives them cost savings returned, increased scale, lower prices, and the circle or the cycle all works together. Amazon, similar flywheel, right? Low
Mhm.
prices, great customer experience, better traffic, more sellers, better selection, yada, 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 right? We all know
Yeah.
the story. So, want to get your
Southwest was
thoughts
the
on
same
that.
idea.
There you
Yeah,
go.
Southwest was the
Southwest.
exact same idea. So,
Hmm.
and there's others too. It's not. It has nothing to do with whether it's technology or not technology. Western Union was similar. What we're talking about is there's a Jeff Bezos quote on this, but basically, it's any company which cuts prices ahead of time when it can't prove that the increase in volume will exceed the decline in the prices initially, but believes that it will over time. So, in other words, you're in some commodity business and you figure this happens all the time where you figure, okay, I can reduce my prices from $100 a ton to $95 a ton, but the increase will be like greater than 5% of my volume. So, I should do this. But that's a projection for this year. What Amazon would do is say, we can't prove that the increase is going to be bigger, but we should cut our prices now. And so they talk about it. Well, I mentioned Western Union because Western Union always called them pricing investments, but it's the exact same idea. They would cut their prices over time, and so the cost of what's essentially like a wire sending these money from one place to another um, fell all the time. Now, there's others that did similar things and didn't share that, right? So that's where you get your really good businesses, your like Visas and Mastercards and all those things, where they get a lot more scale, and yet they don't have this idea of cutting prices as being the way to drive further volume. Um, and then there's lots of other businesses where if you did a comparison over time, you realize, oh, they haven't really gotten much more expensive. If you look 100 years ago at candy companies, soda things, whatever, you might think, oh, they're raising prices all the time. They're not, because they've changed how they package things. And so their prices actually stay pretty low because they have so much scale. They're not thought of the same way as focusing on keeping costs really low and giving it to customers, but actually their profit on each unit is like in real terms is down over time. They're just doing so many more units, right? So it's normal in a scaled business like that. Cruise lines are also similar, but with each of these you have the problem that you have a constraint. I talked about Village Supermarket. Village Supermarket would have the same model, but they can't keep opening up new locations and everything. So there's a limit to how many people that causes overcrowding in one location. You can't, it's very hard, zoning rules and all that. Get approvals, get all this to open up a new location. It's not like what you have with a Costco or even better in Amazon where they don't even have to worry about those things. So you run up against that. Southwest had it for a time, but eventually you've taken away much of their competition was bus stuff early on. That's who they're taking the business from. You fill up all the gates, you do all that, you end up starting to be in highly congested airports and all those things, and you run up against a constraint again. Um, you know, I don't know that Walmart was able to do this kind of model too much after they got out of rural areas and in other sorts of places. But some of that was also they're facing tougher competition because then you're competing grocery and stuff with people who are in suburban areas as good or better than you, whereas they would never face that in rural areas. There's very inefficient grocery operations in rural areas. So I think it's a model that makes a lot of sense up until a point that you will reach constraint with that. And this was about those that can get really, really big in a huge market. The other thing
Mhm.
about it, though, is the model is built on the idea of faster turns. So your margins could be lower, but if you have good turns, if you have lower capital intensity, you have to invest less yourself, then this model makes a lot of sense. And then if we get from that, we could talk about Dell Computer, whatever, where they're basically operating because they're on a negative working capital cycle is how they got started. And so they're able to do that on what looks like low margins, but they're not investing any money in the business. You're usually squeezing the other side in some way, either by getting them to extend you long payment terms, or you could be doing it through getting them to accept lower margins, right? So, you're helping your customers out a lot and hurting your suppliers a lot.
Mhm. Do you agree with him that this sort of traps the business?
I think it's a very specific system. It will work for a period of time and have great returns, and then after a generation or two or whatever, someone else will overtake you. And the problem is that it's such a integrated systemic advantage that you have that will unravel, like we saw with Southwest, right?
Mhm.
And so then you'll fall. And the question is, how far will you fall? If you're an airline or retailer, you could fall to really bad places. So, I think I would like a business with this kind of thing, especially to the extent that the founders around.
Mhm. So it's really like a
We haven't
market share
seen,
thing, right? It's great if you want
yeah.
to try to go get market share.
Well, it's interesting because like Southwest never focused on market share, whereas others did, but they did keep cutting their prices. And they didn't raise their prices when they could have made more money in some cases early on. They just basically, like Costco, like we're kind of just saying, let's not raise prices on certain routes. Costco would say, let's not raise prices on certain things that we do, because I think there's even a discussion behind the scenes at Costco was, yeah, we could do this and no one would ever know because we got it at a ridiculously cheap price for some reason on some products. But it would look like we were doing our normal markup. But then if we let people inside the organization do this kind of markup, then that means that in other cases you'll come back to me and say, I want to do the markup on this and this and this. And soon there'll be 100 SKUs, 1,000 SKUs that we're doing this on, and we won't have the same model anymore. Um, Yeah, so I think it's very powerful. I think most of them though are highly associated with a single founder usually in the
Mhm.
period where they're successful, and I don't know how many last more than 30 years or something of success that way, but it's possible. There's a lot of them in really smaller companies that you just don't know about because they top out at a much lower level. And so the thing is with a Costco or with Amazon, with these retailers that cover all sorts of things, then it's a really, really big market. And so they can keep repeating this in place after place. There are other ones in other industries, but the industries are just so much smaller that you wouldn't notice this, and then they top out somewhere. But at some point, you will reach constraints on your growth, which will be a problem because you've been using that to improve your price cuts, basically. You've been using that to always be a step ahead that way. And at some point, the engine will kind of stall on you,
Mhm.
right? Because things like Costco and Amazon stuff haven't invested, let's say, in advertising or in doing other things to increase anyone's desire to use them when their prices are different or their convenience is different than someone else, right? So
Mhm.
that's kind of the problems that you face. Um,
Gosh, Costco's valuation 390 billion, 52 times earnings, 58 times free cash flow. EV to sales 1.5, but for a company like that, that's still pretty high. It's just crazy. Very expensive. Do you have any thoughts on Costco's valuation? I mean,
the
they're
stock
going
price,
international, right?
yeah, the stock price is too high, but there's always the argument that if you're in the business and it's working, then why not keep holding it? I don't know that I would tell people to sell something like Costco if you thought that nothing was changing with it. You know,
Mhm.
the reason to get off the train in Costco, Amazon, Southwest, when I mentioned that, or Western Union, or their cruise line things that I talked about, or whatever, is when you think that there's something about the model that isn't working anymore, and that's why you have to get out of there. But it's just a question of like how far will you fall. I mean, the thing that worries me with some of these is if you look at, say, Intel, right? Intel probably has half the market or more. There's a leader, let's say, at least in many of the things that they were the leader in a long time ago. You'd be surprised in terms of how many, you know, how many home computers and things still use Intel stuff, how many things in an office would still use it. And yet the company makes literally no money now and
Mhm.
hasn't really made money for like 2 years. Um,
Why is that?
um, there's there's a lot of problems going on until you can see most clearly in the gross margin. Generally, that's why you want to get out as soon as you're seeing that. I mean, has the gross margin even ever increased in the last 10 years or something? No, it increased once, I guess, for a little bit, right?
Mhm.
Yeah, it did increase once from 2016 to 2017 increased. But in all other periods, gross margin has been decreasing, which would in this industry would be a warning sign probably. If you had to measure one thing that would be helpful, an improvement in gross margin in that kind of business is good. A decrease in gross margin is bad. That's probably your best signal in a semiconductor type thing. Um,
Why is that? You would think with scale and bargaining power and all that sort of stuff that that would not happen.
but they did top out, like when we talked about so like on relative scale, I don't know where I was saying that they're still very big, which is true, but on a relative scale basis, it's not like they kept gaining relative scale. I mean, one thing when we're talking about Amazon, Costco, et cetera, is they have historically, even now, been gaining relative scale.
Mhm.
If you look at Costco, even though they're much slower the last 10 years or whatever, they're still growing faster, even in just an item like revenue, than the industries that they're in, right?
Mhm.
So
Mhm.
they're a little bit bigger versus competitors every year. And in all these things, actually, it's generally relative. It's not generally, it is relative scale that matters. It's not very important what your overall scale is, how big you are, although companies talk about that. It's not really that important if you have 50% market share and everyone else has, if you had 50% market share and someone else had 45, that wouldn't be better than you having a 10 and everyone else has two. It's really your market share divided by the other person's market share, the next closest competitors, really. That's what we're talking about. And so gaining scale that way is helpful. Um,
Mhm.
but it's also, when we talk about scale, it's also based on, I mean, an individual Costco is pretty big. And it gets complicated because we can talk about individual planes, individual stores, etc. Individual lines that you have in certain things is where the scale might come from. You have to really look at what things a company is doing and what it's actually saving money on versus others. Having I'd take the semiconductor example, having a highly diversified semiconductor group, I don't think would provide benefits of scale, but having a single blockbuster product would definitely, you know,
Mhm.
drug companies, a single blockbuster product would provide a lot of scale, but there would also be some scale from having a portfolio of many different drugs. So there's some benefit to that too. I don't know that there's much benefit from that for others. Um, So it depends on, are you talking about like the manufacturing function is the most important thing of doing it yourself? Is it design things that you're doing yourself? Is it the amount of buying that you're doing, like Costco, of a single product in a certain quantity? Is it, where's the scale coming from? I think is always important to talk about, and not just how big something is.
Mhm.
Um,
Yeah, that was your tell with the gross margins. Aren't they, likely gonna get bought out or something like that?
yeah, there's a few different possibilities of
The
people.
bear
Intel,
hug.
there's a few different possibilities of people trying to buy them. They're also trying to pivot into other things. But it's not like you really would have had to look at gross margins. People who follow these industries know that Intel has been, I mean, we only go back 10 years in that. It's been longer than that people who are following technology things have been saying that they're lagging other people and that it's a stock to avoid and everything. It's more the
Mhm.
value investors who would have been investing 10 years ago in Intel.
Mhm. Hmm, interesting. What are some other good businesses that have this concept of scale economy shared?
Well, mainly it's going to be very broad retailers. Like you have Amazon and Costco and Walmart are the best examples because they're also similar to doing the exact same thing. Um, It's also gonna make sense as a retailer more than other things because there's some issues with doing it in other industries. So the benefit to a retailer is that doing this to shop with us is really something where you can capture all that benefit for yourself, and you don't necessarily improve things for the industry overall. The problem with something like Ford, which I think he mentions in that email, in
Mhm.
that question, is that, of course, then that creates some issues. We're seeing that with Tesla, which I've mentioned a few times. The problem is that you could then create a bunch of used Teslas.
Mhm.
And you also tend to create other things where, unless you're fully integrated in terms of in-house doing everything yourself, you're also creating a group of companies around you to support you that can also support your new entrants and your competitors in it. So, if you need if you're doing some special things yourself in-house, then yeah, you're gaining that advantage and that scale over time. But if you are doing some things that are somewhat outsourced in terms of what's supporting you, then there'll be more support for the next one that tries to come into the industry. So generally, Ford made it easier for others to come into that industry. But on a relative basis, was making it harder because they were getting better faster than others were. But they were also making it easier for others to just start up a business and have more support from other things. And even something like Tesla or whatever does benefit from the fact that there was existing infrastructure for making cars in the United States that weren't electric. I mean, Tesla, the companies that they use for a variety of different accessories in the car and stuff are just the same things that other major manufacturers use. It has nothing to do with whether they're electric or not. So you're not starting everything from scratch that way. Um, the benefit from Amazon and Costco is, to some extent, to take a cynical view of it, they're not really helping the companies that they sell through them as much as others would, right? So they get to
Mhm.
capture much more of the benefits themselves. In other industries, you're helping the companies that you deal with closely a lot more. Um, so Amazon and Costco are taking advantage a lot of a base of suppliers that's pretty broad, and they aren't helping any one of them too much to get too powerful. And were that to happen, they might, try to get to drop them and everything, and still have a great deal of power over that. It doesn't work perfectly all the time. Some of them have had problems with some of the Walmart wasn't able to get away from some private label things because they were using someone who ended up bigger than they were. So there's some cases where there's a lot of bargaining power with them because, on a relative basis, they're not that big. Costco had that problem, I think, with Coke, right? They had a dispute with Coke, wanted to get rid of them, and that's difficult because you don't have that many choices. So
What
there are
what
many cases.
happened? What happened with that situation?
I don't. It was a long time ago, so I don't know how it was resolved, and they didn't publicly say this is how we resolved it. But I would guess that it was resolved without being terribly in favor of Costco.
Mhm.
So you know, that's always going to be an issue where you have suppliers that are as big or bigger than you are.
Mhm.
There's a limit to how much you can do with that. I mean, they could try to say we won't buy this razor brand, we won't buy this brand of whatever. But if you do that too many times, then people don't want to shop in your stores. But the Costco model is very good, um, and it works. There's a limit to it, though. I mean, I've shopped at Costco and I don't use Costco, so it doesn't appeal to everybody. Um, Amazon is more likely to, be something that appeals to everybody, obviously.
Mhm. I was say, is
But
there a technology aspect to it on where it could be very successful?
I mean, technology allows for greater scalability of it, but it isn't a technology specific thing. I mean, it's usually so to do pricing reduction investments, there's a few ways that it can be done. One, you could have very large stores, very large units. Two, you could have a high degree of investment in capital. Three, you could have a high degree of investment in technology. Four, you could have a high degree of investment in advertising. Now, accounting wise, they're all going to look different, but they're all telling you the same thing, which is that you have to put a lot of capital up front into something. And even a price reduction has similar, things that you're doing. So you're basically saying that you're going to change the structure of the industry to benefit you more over time by doing this. And you're increasing the fixed costs of what you're doing and decreasing the variable costs. And in most industries, how the early leader gets a lot more power over it. If they were to seek it out to be the one that would dominate the industry, what you want to do is to greatly increase, to turn variable costs into fixed costs. to increase the amount of investment it takes to start something up, to make it so that now you can't have a 5,000 square foot store. You need a 50,000, you need a 500,000 square feet, whatever, to keep other entrants from getting in. You want to shift things from variable type stuff to fixed stuff, right? You have to have a base level investment all the time. You have to buy a certain minimum order size. You have to, whatever, you're upping the stakes that have to happen all the time. And then you're hoping that your subscriber base, your customer base, whatever, is large enough to be able to absorb that very high overhead that you have effectively. Because the commitment of someone like Costco or Amazon or whatever is really high compared to someone just trying to compete with them now. You are, and so you're trying to consistently make money that way. But I mean, I think that works for as long as the system is effective that way, but it is a question as to when that system breaks down. And it mostly happens because you suck up all of the available business that you have that way. Like Amazon is a good example. Probably 5 years ago is when Amazon's share of my online purchases peaked, right? Now, I would have been a customer with Amazon for about 20 years before then, but that's probably going to happen with all customers. There's no reason to think that Amazon will have a larger share of wallet after they've had a customer for 20 years. So if you were an early adopter of Amazon things, you would have already topped out years ago and be using other places more often. So it doesn't mean that I don't make the most purchases of anything with Amazon. I probably do, but it's definitely been losing share consistently since then.
Losing share to what?
Everything else, a lot of direct stuff. Everyone has adopted many of the same things as Amazon, so why not just buy from a manufacturer? It's more reliable to go to their own website than to use Amazon.
To be like Jet.com, Walmart.com. I constantly hear people that like talk about how great that experience is. Other smaller retailers.
Yeah, it's easy. I mean, it was impossible. We're doing a podcast right now. Let me tell you that when I started a podcast in 2005, 2006 or whatever, it was really hard to do. Now it's easy. No problem. It's really easy to set up a store and sell things to the web now. It was impossible when Amazon got started.
Yeah,
it wasn't just impossible for little sellers. It was impossible for big companies to do it. So Amazon created all that, but now that's all out there for anyone to use.
Yeah, weren't we talking about recently, privately? Because there's been innovation, a ton of innovation in the podcast industry, even since we've been podcasting, right? We should have been the ones to do it. We would have been the perfect entrepreneurs to use something, know how it works, understand what could be very helpful and beneficial, and go and create it. And a lot of those tools are available now. What we're recording this on right now, StreamYard, it's a great platform. I wanted this back in 2017, 2018. So it is kind of funny how that does happen. Yeah.
Yeah. So I mean, the leaders will. You'll get to a certain point where the leaders will lose share over time for a variety of issues, including it's easier to get into the industry with some of these things. When there's a big boom in terms of CapEx or whatever, and there's capital that you have, that helps. And then the other thing that you have is like they become the experience that people don't want. The things that people will complain about will start to be the things that Costco or Amazon or whatever does if that's the main place that they shop. It's hard to be number one that way because then other people will be able to compete with that by saying, let's take a different model that people like better.
So generally, it sounds like you like this model if it's founder-led, owner-operated.
I think it creates lots of money for a generation or something, but then probably
over time
implodes.
Yeah.
So, I mean, the thing with it did with Southwest. Why? I'm saying, why is Costco going to be different than Southwest or something?
Maybe that's the question. Why is that? Or why will
Only
it not be?
Just culture. Just culture. As soon as the people aren't the same, So there's already been changes in terms of literally who's running Costco. But as long as they're committed to that, then you won't have that problem. But that's a problem potentially people ask about Geico and Progressive. It's a problem. It is a retailer is very similar to like an auto insurer like that, trying to do low prices and everything. And it will work. But I think people think that retailers are a lot safer than those auto insurers. And I don't think that's necessarily the case. As long as that culture stays in place and they pursue that every day, then that's fine. But if you think that Southwest could half pivot to adopting some things that other airlines do and not others and stuff, no. But they already have, Southwest has already moved a lot of other things to being more like the other airlines anyway. So it's different and has been for a long time. But if Costco says we'll do halfway to what others do, if others, Amazon, any of these things that we're talking about start doing that over time, they'll get away from some of the things that they were focused on initially. Others will be able to come in and compete with that. You know,
Mhm.
I mean, you have a model here which basically requires you to have volume growth to drive price reductions, to drive volume growth, to drive price reductions. If you start to lose market share and have volume decline, what happens? And that would be
Mhm.
the challenge that any of them face that way. And so, I mean, if we're asking in like a steady state, is a retailer like this safer? I mean, you're in an industry in which you went from no market share to a lot of it by grabbing it over time by doing these things. Unless you somehow change the industry so that's not possible again, that's the problem. It's the problem of social media things that did something by being very viral and stuff. Unless you made sure you seal that door very safely behind you, you're in an industry where something could have incredibly rapid growth to compete with you because you did it. So the same methods presumably exist for someone taking away a lot of business from you if it's the next thing.
Mhm. Got it. Let's hop over to some questions on X. And first question that somebody had sent in: PSU incentives based on stock prices like Tesla and HROW. Thoughts? So performance, was it performance share units? I believe is the acronym. Yeah, performance stock units. And you get certain tranches based on share prices. Do you have any
Okay.
thoughts on that?
I mean, it's easy to calculate. So it's easier for me to do than what most programs look like. What you just showed me is a lot simpler. Usually it's pretty hard to figure out um, what is actually being said about when things will be. Uh, yeah, that's awfully simple what we're reading there.
Mm-hmm.
If it maintains for 10 consecutive trading days and all that, yep, that's really simple.
Mm-hmm. I guess
I mean, we talked
does
a little
that.
bit about this before. I don't think these things need to be overly complicated. If you say that in some big upside situation, we're going to give you a lot of money, then I think you've incentivized people. Um,
Mm-hmm.
so, but there's a lot of ways that effectively do the same thing. And many of the things that they give to executives, it has the same thing, which is if your stock price goes up a lot, you're going to make a lot of money. This makes that really, really plain.
Oh, it's like the court that blocked it though for Elon.
Yeah. Well, yeah, that's a complicated issue because you have the problem of that we could talk about, with any of these things, which is the problem of, uh, you know, should you pay someone a lot of money if they're not going to leave? You know, I mean, if you're asking like, should the company do the right thing and have paid him a lot of money to keep him because they actually believe that he could leave is a risk if they don't do that, then yeah, they do the right things for shareholders, right? But
Mm-hmm.
if that's the argument, then in theory, a CEO or whatever could extract all the value that they create for a company from boards all the time, right? Because they'd say, why every year doesn't Jeff Bezos say when he was at Amazon, well, I'll just leave and start up another company and stuff?
I think it's worse than that. I think he negotiated that, and it was voted on by shareholders years before Tesla had the meteoric rise, and then it
Mhm.
hits, and then they weren't able to pay it because of a court ruling on something that
Mhm.
the shareholders voted on. That seems a little bit too like communism to me or something. I don't know. I don't know what it is, but that's not capitalism in my eyes, you know? It's a bit bizarre. And funny enough, he reincorporated all of his companies in Nevada after that instead of Delaware.
Uh, yeah, well, that's what will really change it is that courts won't do that because of that reason. If Delaware starts losing some business to Nevada or
He
Texas
also
or whatever over time.
encouraged other companies to do that, which who knows if they did. But,
This is what happens with regulatory things all the time, is that they all end up going to the lowest. It's a race to the bottom that way because everyone has to change all of their rulings and all of their legislation and everything to make themselves the most attractive venue. If there's nothing else keeping them there, Delaware is a state of convenience anyway for them, so they'll just go to another state of convenience. So,
let's see. Any thoughts on P&C insurance market and what investable opportunities there may be in that current market? So thoughts on any P&C stocks?
we've talked a little bit, I guess. Let's see. What did we talk about? I mean, I guess Berkshire at one point bought some Chubb shares. We probably talked about, I just mentioned auto things, but I know that you'd mentioned things about, how Geico's doing versus Progressive and all of that. One that's not so direct, if you could look at HomeServe, that one's the ones that someone may not have heard of because technically it doesn't describe itself as like a PNC. I'm sorry, Front Door. Front Door. We'll look at Front Door. HomeServe is fine too, but we'll look at Front Door. That's the US. It's a US stock, so it's better.
Mm-hmm.
So this is just helpful in terms of understanding what happened. So if you look here, what this company does is they offer, home warranty plans in the sense of, I think they operate under the one that's probably best known in the US for people watching cable or something would be like American Home Shield, something
Yeah.
like that.
Mm-hmm.
So, it's going to be that you're going to just pay like a one-time price per visit or something for a repair plus some like max amount. And so you've basically smoothed it out. So if you need to have appliances fixed and whatever that are covered, plumbing things that are covered by the policy that you take out, then, it smooths it out. And this is very attractive, especially to senior citizens and all that kind of stuff. But I just pointed out because it has some of the same, basically what it is doing is being a insurance company, even though that's not how it's described. And so if you look over at gross margin, I think you could see this best of what happened during COVID. If you see a pretty stable margin historically, right? I mean,
Mm-hmm.
not in all years, but pretty stable. And then you have this big decline there and then improving from that. But you see on that base that generates a lot less gross profit than they might expect, which drives operating profit down a lot. So you had almost, it wasn't a 50% drop, but what is that? That's a very big drop. Let's see, 40% probably, yeah, drop
Mm-hmm.
in operating profit in what's normally a company that doesn't have a lot of those kinds of declines. And so that would happen for any kind of insurance thing when this happens, where the cost went up so much. So is an issue where the frequency is normally more the issue. So if you look at previous years, with a company like this, they'd normally say, oh, there was some storm in some part of the country that caused like all this higher frequency than we're used to or whatever. But it's not usually that when we went out we had to pay service people, so much more money to go out there and repair things. And the actual cost of these things went up so much during COVID. So, that's what happened. And then as a result, you have improving things as inflation slows down. So if you're betting on lower inflation, inflation slowing down everything in the near term, then I think insurance things are pretty good. They're not very economically sensitive, and they do benefit a lot from having higher inflation in the recent past that's slowing down a lot. That helps them push through higher rates in the past. And then, the actual costs come in lower. What you don't want with an insurer generally is when you and or the insurer and or everybody is expecting lower inflation than actually happens. That's the big risk.
Mm-hmm.
And it hurt here with COVID, but it really killed people in the 70s. They had constantly predicted that inflation would slow down when it didn't. So,
Here's something. Any other podcast recommendations? What's on your
yeah,
your playlist, Geoff?
I don't listen to a lot of podcasts, and mostly I read business book things, not listening to the podcast. I did mention that I thought Founders Podcast was a good podcast because I had avoided it for a long time, thinking it was about Steve Jobs, Elon Musk, whatever, very, very recent founders and covering them, 10 different times for that one founder or whatever, but it does cover people from the 1800s, 1900s, more obscure ones. So it was much better than I thought it would be.
Mm-hmm.
So I would recommend that because it's a way to find more books.
Mm-hmm.
Any podcast that can recommend things to you, I think, is a good podcast that you can use it to find other stuff. So
Mm-hmm.
discussing books as a podcast is always a good choice, I think. What about you?
Mm-hmm. Founders podcast. I don't listen religiously, but sometimes every now and then I'll see it come up like, oh yeah, I'm actually interested in that person. Or if I do come across a biography or an autobiography about an individual, I'll see if he did a podcast on it. And oftentimes he probably has, even
Mhm.
obscure people. So I don't really, I do think his podcast is amazing though. And he seems like he's doing amazing work, David. But I would say more so the podcasts I listen to are market related. So
Mhm.
I like Meb Faber, Ford Guidance, although the guy that hosts that podcast, I think he's doing something else now. He just
Oh,
tweeted about that. Um, let's see what else. Hmm. I like Value Hive. Um, yeah, I do listen to All In, the podcast. Now that's much more like, I would say, top down, like
okay.
economy and politics and like what's going on in tech. I do like to get the different opinions. I think they have pretty cool guests on there. Of course, you know, I do. I don't listen to every Joe Rogan podcast, but every now and then when he has someone on that's interesting, I like to listen to him.
Mhm.
Like he had Peter Thiel on. Listen to that. Lex Friedman. I would say I don't listen to like every podcast religiously unless they have a guest on that I'm interested in or they're talking about something that I'm interested in.
Mhm.
But no, podcasts are definitely, I do listen to a lot of podcasts, but I listen to or watch a lot of YouTube. That's like my
Okay.
form of entertainment, I guess, is YouTube. So Rogan on there, Lex, All In, different podcasts. If I'm interested in an investor and they go on something, I like to listen to it. I definitely watch and listen to a lot more YouTube than I do just on the podcast app.
Okay.
Yeah,
Yeah. And we're on both. Some people can get us both ways.
that's right. That's right. Let me see. Let me pull up my podcast app because I just want to make sure I'm not missing
Because podcasts,
anybody.
they could never. I mean, with Joe Rogan, I guess is technically not a podcast now because of that. But podcasts, they can't take away.
Hmm.
YouTube, they can. They can. That's their choice if they want to get rid of our channel.
One thing I'll do too is if I'm interested, um, here we go. American history tellers. That's like
Okay.
American history, like that. Um, but unrelated to investing. Um, if I get interested in like a particular industry or
Hmm.
sector or commodity, the first thing I do is I go, not the first, but one of the first things I do is I try to find a podcast on it. So we talk a lot about
Yeah.
entertainment, right?
Hmm.
There are podcasts and movie theaters. There are podcasts that are dedicated to the box office.
Yeah.
So I like
Yep.
to chime in and listen to that, right? If I'm interested in um, energy or a different commodity, grains. This past summer, I
Hmm.
was just for whatever reason interested in corn and just kind of just seeing what was going on there because of floods that were going on and droughts or whatever. I found a grain podcast. I just like to listen and go and listen to like
Hmm.
experts in their industry. So it's actually part of a research process for me. But like I said, I kind of hop around. I go by if it's a topic I'm interested in that person or podcast is talking about. So,
Hmm. Yeah.
but it's a good way
I
to
find.
do it. You know, when we talk about like the box office or whatever, there's people where it's basically like a magazine. This is their entire life.
Mhm.
That's all they focus on, right? We kind of come in and out of these industries and we focus on a lot of different things. And it's like these people, this is all they focus on. So it's good to
Yeah.
go in there and get their thoughts and hear what they're doing. I mean, Box Office Pro, I believe, is the one that I listen to on uh, as a podcast, which is about the box office, obviously, and movies and all that sort of stuff.
Yeah, the podcasts are basically magazines. I mean, that's the real economics of them. I mean, when you're talking about Joe Rogan stuff, that's like a radio station that covers the, globe, the country. But generally, there are these niche things that focus on what used to be what you're talking about there is like there used to be all these trade magazines and everything, but there was also specialty interest ones. I think
Mhm.
Munger gets quoted on talking about how they were getting killed by this motocross one or whatever, because he was saying just the economics of a magazine focused on one particular thing used to be really big that way. And it's helpful if you're a hobbyist or whatever in something. Um, so it replaces that kind of thing. I mean, look, what was it? What did I say? Yeah, if we go back 25 years, I would have read like PC Gamer magazine or something, right? So that's just focused on that one thing. It's not a trade magazine. That was more of a hobbyist magazine. And then you have
Mhm.
other ones that are actually trade magazines, like you said, which is more like that's kind of replacing the Box Office Pro stuff. Is kind of replacing like Variety and all those, which printed all that.
Mhm.
The numbers, yeah, the numbers is a good place for data. There's definitely places I go for data that I find very useful.
Try to get their
Um,
publication, their magazine that comes out
yes,
monthly.
they have a
Yeah. I
business report.
think it's
So
like
we've mentioned that
65
before.
bucks, $65 a month or something, and yeah.
Yeah. So the numbers, that's the word the, then a dash, and then numbers.com is the best place for box office data, really. There are more famous ones that used to be good, but I think people who really are interested in the data all use this. Even yeah, I think they're using it. Other sources that I'm seeing and stuff, I think are actually probably regularly checking this because it's just better than the ones that are owned by the big companies now. So, because I'm sure people know originally, like Box Office Mojo was probably the first one that was a regular thing that I think articles started citing and everything. But that is a useful place if you want to see real data on all that stuff. Um, yeah, I don't listen to as much of the things that are, let's see, like I did in the early days of podcasting. I listened much more to podcasts that would be similar to ours, I guess.
Mhm.
I talked about how I listened to the Value Guys. That was the best podcast that I listened to because they did individual stocks every time, and they used Value Line, which I would be reading all the time then. But that Value Line got annoyed at them, and
Mm. That was the
but that's a
best
good one to just
marketing. That was the best marketing for Value Line too, probably.
yeah to just go through industry groups, right? Because Value Line is organized by industry groups, so they would have to make picks through different industry groups, and then you'd cycle through it once a quarter. I do still recommend all of that. I mean, I can't recommend Value Line because it charges a lot and then has those problems, like we said. So I can't really recommend it as an organization, but as a publication, that kind of thing, or creating something like it for yourself, is a good thing to do.
Mhm.
And that podcast was excellent. Yeah.
Mhm. Okay, let's see. We can move on to the next question. How will the possibility of more damaging storms impact the insurance market in the short and long term?
I'm not worried about it, to be honest. I mean, the policies get repriced pretty quickly and everything, so it's not something. Well, okay, so you have Universal there. If you're talking about like how will it affect Florida and the politics there for things that individuals have to buy for their homes, that's a
He did
different story. But that's a
specifically
whole.
reference the Florida storm,
Well, yeah, but I mean, I think that did a lot of damage outside of Florida,
North
and I don't know if
Carolina. Yeah.
that's
Hmm.
specifically. Yeah, so if we're talking about shifts in societal attitudes, in regulation, whatever, yes, I would worry a lot about Florida long term because of the um kind of political environment and everything. Yeah. It's a really big kind of political issue. It's effectively like having a tax in the state. So could a state make bad tax policy and get into deficits and have trouble, refinancing and everything? Yeah. And they
Hmm.
could do the same thing with homeowners insurance. Some states have with car insurance in the past, I can tell you, had problems with some of the policies they adopted, just didn't make financial sense for the insurers, and so the insurers withdrew from those states and everything, and that's pretty normal. So I would worry about it in a state where it's that important. Outside of Florida, I don't know how many states there are where all the voters are going to care so much about the issue that it leads to possibly irrational policymaking.
Hmm.
But you would know more about that, Andrew. What are your thoughts on that in Florida?
I think they're going to go up. Yeah. I mean, Florida's insolvent, basically, or the insurance there. And it's basically state ran, is what majority of the people are on, citizens.
Mm-hmm.
And premiums probably need to go up. Yeah. And I mean, they were talking about that at the Berkshire meeting too. Ajit Jain and Buffett were talking about that in Florida.
Yeah, the things I worry about in insurance, honestly, are not this makes the industry sound darker than it is, perhaps, but they're not really the actual natural occurrence of things that we can all agree really happened or will happen and increase in frequency. They're how human beings will deal with those things, what policies they'll set up, what systems, how smart or dumb that is, what that can create in terms of fraud and other sorts of things, expanding ideas of what risks are covered and just disagreements over that. And but if it's something as simple as, how many storms of this kind, named storms, will occur, an earthquake of this magnitude here, whatever, the policies are adjusted. You know, uh, I mean, I wouldn't worry more about those insurance things than like, we don't talk too much about that when companies make long-term loans, banks and things, and say how different will the interest rate environment be, down the road. These companies are much more nimble for the most part, the insurance things we're talking about, to adjust to that than all sorts of contracts and agreements that people enter into all the time. So it can be adjusted for being more really bad storms. I don't worry about that. And overall, that would make the industry bigger. I mean, if people, you know, if we have self-driving cars that cause accidents to be nothing, that's actually more of a risk to an insurer than we have a lot of terrible storms that cause them to pay out a lot in losses. Paying out a lot in losses is their business over time, as long as they price it right. So lots and lots of
Mhm.
losses aren't a negative for the industry as long as it's priced right. And whatever your thoughts about global warming or whatever, it's not a question of things changing dramatically in a single year or two or three. It's a trend that you can see over time. So I think that that's not potentially a problem. But I do think certain states, certain places, yeah, I think that it could be a problem, because if that gets to be a big number, then people are going to say, this is something we want the government to be involved in, and this is something I care as much about when I vote as the quality of my schools and what my property taxes are and stuff. It becomes a top issue. Then
Mhm.
yeah, it's gonna be what people want, which probably won't economically work that great.
Mhm. Next question. Hashtag Jeff really seems to have a great interest in entertainment companies, movies, etc., but I never really heard him talk about owning them. Just never cheap enough? Question mark.
That's a good question. They're all let's see, the Twitter handle there, oh, X, excuse me, is small cap value, right? Small cap
Mhm.
value, yeah. So I'm just mentioning that because, yeah, there are opportunities in small cap value entertainment things. I think mostly it's because I wouldn't own the big giant companies, to be honest. But we've talked about that with banks, where I've said, like, look, I probably wouldn't own Bank of America, Wells Fargo, JP Morgan, and I probably wouldn't own the biggest entertainment companies. The biggest entertainment companies are super diversified, and I don't see a lot of opportunities in them either, in terms of interesting capital allocation that they do, interesting leaders of the companies, and just like pricing things. But we point them out when we talked about Cinemark and Marcus. So that's like a they're both considered small stocks, but Marcus is really small and Cinemark's whatever, mid or something at this point.
Mhm.
Um, so or I guess Marcus would be micro and Cinemark would be small or something. But yeah, there are opportunities in those kinds of things.
And we do have or have had exposure, even if we don't
Yeah.
talk about it on the podcast. But yeah, we do or have had either or.
Hmm. No, that's true. It's just that it's smaller and less well known and stuff is generally the case. Yeah.
Mhm.
Yeah, I've owned entertainment things before myself, and over the years, plenty of times.
Mhm. How long do you wait before deciding if your thesis is broken or the company is just experiencing a temporary dip in performance?
Um, that's really hard to say. So it depends on, you try to say, here's what we know is happening, and then try to come up with reasonable explanations for why that might be happening. And in some cases that are pretty noisy, you might want to wait a while. I mean, you could get out, but basically you would think your thesis is broken all the time just because the economic environment changed a bit because whatever happened. And so you'd be doing it all the time. In things that are very, very not noisy, uh, then it might be able to get out fast. So, like, let's say years ago, Buffett was invested in Anheuser-Busch, right? If he's seeing volume declines in there that are more than he expects in that, then you could get out right away. There's very little noise in the actual, if we were talking about actual consumption trends, if you had access to that data of what's actually being sold to the end consumer, and comparing market share, right? And we know he was a subscriber to this one that covered the soft drink industry, but not necessarily hard beverages and stuff. But if you had that kind of data, you could get out on very small. I'm talking just very small incremental loss of market share. You should get out. When I talked about Intel, we said, look at this gross margin stuff. If you knew the industry really well and saw better gross margin at other places and worse at Intel, then your thesis, your original one, would have been wrong. It maybe would say, okay, but it's justified by the stock dropping and there's some other thing that's going to happen that's going to work out, so I shouldn't necessarily sell the stock. That might be the case. But obviously, you'd have to accept that they were in a worsening position over time. In other ones, it's really, really hard. So fast changing, noisy, etc. So any economically sensitive thing, it's nearly impossible because you don't know what we're seeing in terms of how much of that is macro type stuff. So you're looking at it and you're saying, oh, it all has to do with this company, but it's macro type things that are happening. So in most industries, we don't have the kind of data that we're just talking about with box office data with the numbers. We can't compare each company to every other company at all times and see that, oh, they're not actually losing their relative position or something, you know?
Mm-hmm.
And that's on the negative side. On the positive side, where you could misunderstand that would be like AI or something right now, where you could be making a lot of money, but you don't realize that it's like, well, some places like they just are not even able to meet customer demand. And so you don't have anything that's impressive, but you're getting orders or something. You know what I mean? That would be the kind of thing in the opposite direction where it's noisy and you don't realize that a rising tide is lifting all boats and that on a relative basis, you're not looking that good. But it's mostly if you have really clean data on a relative basis to be able to understand those things. I think it would be that would be the best way to do it. It's just a question of how much noise there is.
Mm-hmm. Let's see how to think about companies that have hidden real estate value on their books if management has no specific plans to unlock its value.
Yep. I don't know. What are your thoughts on that one? I think it depends on the management for one thing, right?
Yeah.
And then it's kind of soft signs of trying to figure out what you think is going on. I would say a lot of it is where the idea is sourced from normally. If you got the idea because it was posted on places, your Value Investors Club, or whatever, saying there's hidden value there and there's 3 other posts about this and everything, I would be a lot more skeptical than if you researched this thing and found out that this is the case.
Yeah, I would say so we use this example a lot, Maui Land and Pineapple, right? This was a land bank for some time and the stock basically went nowhere, right? It shot up like crazy in 2007, came down in 2008 and probably traded within a few dollar range for the next, what, 11 or 12 years. But now the stock is up a bunch, and that's because they are making changes at the company, right? And are trying to do stuff with that land. They brought in, I think, a new management. I think they changed the board a little bit. I'm not so close to the situation, but you could see the soft signs were starting to happen. So, that's one end of the spectrum. The other end of the spectrum are companies that we have visited in person, where you're
Mm-hmm.
like, wow, the land value of this company would be many, many multiples what the market cap is, but it's controlled by somebody who has absolutely zero interest in doing that. And you wouldn't want to be locked up in a situation like that. So, me personally, how to think about companies that have hidden real estate value on their books if management has no specific plan to unlock itself, I think it's dead money. Honestly, I think you should go
Okay.
find other things to do with your capital. But if,
And
you see the
yeah,
soft signs in place and you talk to them and you get a feel for how they're thinking about it, then okay. But, because the other end is, yeah, it's good from a margin of safety perspective if they're going to do something about it, your downside is capped, which is great. But, sometimes I'll see um, like a write up on a retailer, for example, that owns a
mm-hmm.
bunch of real estate and the retail business is horrible and the families operate the business for a very long time. It's, second or third generation, and people make a pitch that, oh, the value of the real estate that they own, even though the retail business sucks, the value of the real estate that they own is worth, 2 times the market cap or something like that. And I'm just
Mm-hmm.
not that interested in a situation like that. How do you know that they're going to close their family business and sell all of their properties and do something with it for shareholders? I mean, you don't know that. And I've considered situations like that just dead money, honestly.
Okay.
You want your money to work hard for you.
Yeah, I think it depends on which way that you're finding it. I mentioned before Rex American Resources, which was Rex Stores. That's the one that sold off its land and went into ethanol. It was a retailer, and people compared it to like Circuit City and things like that. Well, Circuit City leased everything, they owned everything, and they had a plan that they started going in that direction. The market did not respond very quickly when they started to sell some of the real estate and buy ethanol. So that's such a strange pivot, even if they're not communicating a lot of things, that what they're doing. And if you wanted to look into that and do that, back, what was that? I don't know, they may have started this process 18 years ago or something. Then, that's not something that the market will be focused on. And you see this allocation a different way. With something like Maui Land and Pineapple, I'd be very careful because it's the opposite of hidden real estate value. It's the only reason why people own the stock, the only reason why people talk about the stock. Um, we've mentioned Marcus. I think the market significantly undervalues of how much Marcus owns in assets and how little they owe versus others.
Mm-hmm.
Probably at times the market's undervalued how much Southwest owns and how little they owe compared to others, and they'll only realize that in the bottom of a bad recession or something. So it is definitely a big factor to consider when you're actually finding those things, if we're talking about actual hidden value. But I think it's rare for someone to come to me and say, look, I was analyzing this company. No one talks about this, but they own a lot of real estate.
Mm-hmm.
Instead, it's the opposite. I'm researching this company because they own a lot of real estate, and this isn't baked into the price. But how is it not baked into the price if all the write-ups and everything are about it?
Mm-hmm.
I would really start from that perspective and try to analyze it that way.
Mm-hmm.
I think it's very important to know where you got the idea from, what ideas are circulating in what way, and how things are being framed. And if no one's framing this with the assets in there, then it's significant. But if everyone's framing this as an asset play, then I think it's not so significant.
Mm-hmm. You could find companies that are like under $50 million that own a bunch of land, but the value
Sure.
they've been that cheap for like 20 years. And yes, I guess the value, if they are going to do something about it, there could be a lot of realized value there. But you know, I don't know.
Yeah. I mean, look, but I mean, if something doubles in the last day of the holding period, that's going to add 7% to a 10-year holding period, right?
Yeah, I get that.
So I mean, there are ones that have been followed for a long time where people did have that complaint. I've seen ones that have been 25 years. The stock ended up outperforming the S&P over the 25 years because when they sold it to a new owner, it did go for a price, of that amount. So I think, what is the ongoing
I
business
think a
like?
double over 7 years or 10 years. I just think that's not that attractive. I think there's other opportunities out there.
Oh, no. I'm not saying that. I'm saying if the stock, so there's a huge difference of what we're talking about if the stock isn't also returning money over time, right? But if a stock is matching the market and then turns out to be undervalued by half, you're going to make a lot more money by that, by it doubling at that point.
Mm.
And so I think it's very important. So banks are a good example of this, right? This happens a lot with banks. People will say, why would you ever own a bank with a 5 or 6% return on equity or something? Well, you would if another bank will buy it for twice what it trades at. So if it can return to you that kind of number, and then at the end of your holding period, it doubles. But many of these land things we're talking about are not like those banks or insurance companies that are undervalued by half and that have decent returns, but not great returns. And that were they ever to be sold would sell for a much higher value. I mean, I think you have to do the math on it on how long is the possible holding period and how big is the discount. Usually the discounts are not big enough to me for it to make a difference. I think what does get undervalued more is like holding companies that the net asset value is perfectly good, but that because they're valued in the market is not as good. And so people say, when will this value ever close? When will, and you're saying, well, the underlying value is matching the market. And there's plenty of examples of that, particularly insurance companies, but it's rare, but it can happen in closed end fund type things and other things that are very similar to closed end funds.
Mm-hmm.
And people say, well, it always traded at half times book. It won't trade at half times book when the family sells.
No,
I
that's
can sell
true.
it for half a book.
Mm-hmm.
Your risk is the family will buy it from you, which I've had happen, but you still make money. But that's actually the biggest risk, is that you as shareholders will be taken out by someone else doing that.
Mm-hmm.
So, I mean, I would go with the Ben Graham thing, which is Ben Graham would say, like, if there's a big net cash position, that may be negative in terms of the efficiency of the company and everything, and seeing that, and you can dock them for that. So you shouldn't value net cash on the balance sheet at 100% of what that cash is. But it is always better to have the cash than not have the cash. You should never value it at 0%. And I would say the same thing with the real estate things. Um, to have additional assets is a plus, and you shouldn't value it at nothing. But I think it matters a lot where you get the idea from, because I think some of what we're talking about is the opposite of when I started in investing, where really it's a pitch about the idea of the sole reason for this is that it could be sold for twice as much, that it has all this land or whatever, as opposed to finding a business that was mostly about something else and it happens to have some land as a result. But there's no doubt that if ever Marcus, if ever that family was saying, let's look at a um, going private transaction, an LBO thing, an acquirer looking to buy them, whatever, they would be looking at financing the transaction differently than if all the locations were leased. So the final transaction will take into account that you own some real estate and you don't lease it. And the final transaction for an AMC or something is that you're all leases. So it should be captured somewhere in the value, the way that we do enterprise value or whatever. It does need to be adjusted for those facts.
Mm-hmm. Trying to find a DM that somebody read or sent me, and I read to you a couple weeks ago, which I can't seem to find because I think it ties into this topic.
But I do think the best answer is to study the company and keep it on your radar and to look for changes, like we said, in anything that management is saying, in capital allocation, whatever. You do run a risk that's maybe some offer comes out of the blue that you never knew about or whatever. But
okay, so basically, I read you the DM, so you remember. I can't find it right now, but basically, this individual DM'd me saying, I'm a super smart guy. I probably have an IQ of this. I did really great on my
okay.
SATs. I have been investing money for the past 4 years or 3 years myself. I'm pulling a value investing strategy, and my return is like a negative 3% CAGR or something like that, right?
Mm-hmm.
Basically saying, am I doing this wrong? Or, should I stop investing? Should I change strategies? Should I index or whatever, right? And my initial reaction or thought towards that is, are you investing in a situation like this, like we're talking about, where from like an accounting perspective, yes, there's a huge
Mm-hmm.
discrepancy there, right? And if they're going to sell the company or someone's going to take them out, yes, you could probably make a ton of money. But, over a 3 to 5 year period, if nothing happens, then nothing happens. So
Mm-hmm.
is the individual focusing on a situation like that? Um, I don't know. That's what I just kind of thought about as we were talking about this.
I mean, I think the biggest risk in that, from what I've seen, is that people adopt the idea of they're supposed to do things the way that it was described, right? So there's a big danger that you just learned a lot about value investing. And so now you're basically doing the things that you think value investing is supposed to be and doing that, as opposed to making kind of common sense decisions about whatever things at a later um, time, when you had some distance between when you learned all these things and when you're doing it. I think it is dangerous for people generally to go right from like textbook type learning to doing this. And it would help most people to manage money for themselves as early as possible and not just be reading things all the time. So the fact that you have a high IQ or are good at studying things or whatever isn't necessarily the same thing as practicing it, because you could have a lot of thinking, well, I should check the boxes of what this strategy is.
Mm-hmm.
Now, it's also possible that the strategy itself isn't doing well. And I know from that one, particularly when you mentioned to me, that's not the only issue, because that would just cause relative underperformance. And that's just, yes, you could be a great investor and have relative underperformance if you happen to commit yourself to, I'm only buying these value things and it's a big growth market for 3 years. Sure, you could underperform. Now, you wouldn't be likely to lose money. That would be unusual. But if the market's going up 20 or 30% in a year and you're not, I don't know that you should quit after a year because of that. Um, you know, so first of all, you would need at least 3 years to kind of judge that at a minimum of anything.
Mm-hmm.
There's no point in at least having 3 years. And of making any decisions without that. And then the other question would be, was your strategy kind of consistent through that period? And how much does it reflect your decisions? The more important thing is kind of what decisions you make that don't fit with the way you were taught. And were those good or bad decisions? That's going to tell you more about like your likely future abilities to do this, to invest your own money and everything. The stuff that's basically following a strategy by rote, decision making, that's kind of like a computer could have done that for you. So it's more the issues we're getting into is like what I would be concerned about is, okay, but did they teach in the textbooks and everything the difference between what I said is you discovered this hidden real estate value yourself, or did you find this by being on message boards? Because that's very different information. And like it's not always explicitly explained in investing books the way that it would be in a book on poker or something about what other information you might have and what risks you might be at of information you don't know, and different kinds of things about the way you have to make the decision with what information you have. And so if it's not as explicit about that, then it might not really have sunk in about how did I get this information, and am I putting too much value on it.
Mm-hmm.
Did I not really consider is something changing, that someone could do something different here from what was done before? Because there could be signs that they are going to do something different. Now, sometimes those signs turn out to be wrong. None of them will be perfect, but you could see signs that are different from the past. So when we're talking about these real estate things or whatever, you could look at the long-term past, look for any evidence of these kinds of things happening in the past and say, okay, this is actually a big difference,
Mm-hmm.
that so-and-so died, or that they've refinanced this thing, or they changed this contract, or suddenly there's a change of control thing in here or whatever, and that's never happened before, or whatever, the board did this. There could be signs that you could take into account. And when reviewing your performance, you might not really be taking that, like looking at that and saying, oh, I didn't see, how did I evaluate the information that wasn't just that financial information?
Mm-hmm.
Because otherwise it would be, I wouldn't even suggest that someone invest on the basis that value investing beats other methods and then just stick to a value investing approach, because that to me is the same mistake as like saying that I should just index. Well, the reason why I think it would not be safe to just index forever is we don't know that can end really badly. And value investing's worked in the past, but we don't know that the market might not become efficient in a way that it would incorporate value investing into it to a sufficient degree that doesn't work anymore. But there'll be some other
Mm-hmm.
way of making money. You know what I mean?
We were just
Using
talking
common
about
sense.
that, right? Ed Thorpe and A Man for All Markets
Mhm.
going into different pockets of inefficiencies, and then over
Yes.
time they become more efficient. But what he was great at is
Yeah.
going from different things. And we've talked about this before. I mean, spinoffs used to be a great place for value.
Mhm.
Historically, as in the past handful of years, they haven't been, right? Doesn't mean that you don't get
Mhm.
a couple good ones a year. It's still a great place to look, but they just haven't been. Stocks emerging from bankruptcy, or Chapter 11, or reorganizations or restructurings, they've been a pretty good place for value. I'm sure that's going to change too. So
Mhm.
I just think markets change. There's cycles to all of these sort of things. When you talk about buying FICO at whatever single digit or low
Yeah.
double digit PE, right? That market hasn't been here in a while,
Right.
so you've had to go and do other stuff. I mean, what they talk about with Buffett doing different things, and Munger would be like, well, it keeps you out of the bars. Like, you just
Mhm.
got to play the hand that you have based on it. And of course, not get caught up in the craziness of the bubbles and things that happen or whatever. But I do believe there's cycles to those things coming out of out of like, opportunity, and that's okay. You got to play, the field.
Yeah, and what drives me crazy about that is when people say those things about those inefficiencies that existed before, and now they say, well, they don't exist now. But that would have been the case back then too. We just don't know it. That Buffett would have been looking at it and saying, oh, these things that Graham could do, I can't do in this generation but I can do these other ones. And there's just always things that a lot of people will wait for kind of the academic paper to come out and to be vetted a couple times
Yeah.
before saying, okay, I should get it. Well, at that point, it's not even a question of whether it goes away because there's a paper on it. It's like there was a lot of money to be made in this for a long time. People have been kind of learning and training themselves on this. There's people starting to specialize in doing this thing. Why should we expect that this same inefficiency exists? And
Hmm.
so when I tell a story about something from right after the financial crisis or in the dot-com boom, yeah, it was inefficient, and you could see it really was. It wasn't some crazy risk to do this. But of course it goes away.
Hmm.
Like yeah, people did learn some lessons from the dot-com thing, and so whatever things happen after that, they'll be a little different. Some of it was crazy in a way that it won't be crazy that same way again. And I don't know if people will be as scared as they were coming right out of the financial crisis of not touching anything financial as they were then. And so that created situations. There will be other panics and people worried about that, but it won't be exactly the same way. And even when we're seeing booms this time with AI and all of that, it doesn't feel exactly the same as the dot-com one. It's not as pervasive, I've said, like outside of the institutional stuff, it's not pervasive in society in quite the way that it was in the dot-com era. And so, like, we do invest in small versus large, but I would say if we started that in 1999, that would have been a better time to start the fund than when we did, because it was more inefficient. It was really more inefficient that people were just doing the blue chip giant stocks and not touching these other little things. If they weren't tech things, if they were tech, then they were. But if they were anything that was boring and small, they weren't interested in it. Now it is somewhat more efficient than that. But that's because after 2000, value outperformed for a while. People wrote a lot of like papers and things all about value, and like there was much more interest in it for a time after that. There was no interest in value investing in like 99 2000. So
Which
and
is the best time
that's
to be
just,
doing it.
yeah, so I'm still okay with looking at the spinoffs and everything, but I mean, every book talks about this as if it's one of the, if like your standard, here are some inefficient things that you could have an advantage, and it's one of the dozen or so that they mention, I'd be worried. But I'd be worried that way too about factor things. If they said, here are the 4 or 5 factors that will cause that are inefficient, that are underpriced in the market, that you could buy and make money, because they're not really risks, but they kind of are treated by people as if they're risks, right? I I don't know, unless there's some reason why they should continue to exist for all times, then you'll have to find other inefficiencies, even things like that. If they're so primary, like so inherent in the market, they're going to last forever. We did do a podcast where we talked about that. That means that they have to be quite painful to people. So, like, if value investing will last forever that way as a way to make money, it's probably because it will significantly underperform in some periods. And it may outperform in periods where, like, say, the market is down or something, where people may not value that as much as consistently year after year doing well. A strategy that is likely to give you a small gain versus other things every year is something that people would quickly adopt, right? If I could market a strategy that says you'll make 3% more a year every year forever, everyone would swarm into that strategy. But if I said, here's a strategy that you'll match the market one year, you'll underperform in a up year, but in the down year, you'll do so much better than it in the down year, even though you'll also be down, that, over time you'll make more money, right? That's like a strategy that could last, that people can keep adopting, right? And so with those emails about the DMs about that kind of stuff, the issue is more like you're playing a game against other people, And so that's why I compare it to poker or something. I mean, I don't know that completely textbook play without a lot of practical applications of it would necessarily give you a good idea of how what you're doing varies from what a machine being taught the same thing you have, is like, here's the rules of how to do things, would be doing. Otherwise, you might just be, it may be that you're diverging from the strategy that's suggested in ways that are bad and negative in terms of value, or to add to them. Most people that I talk to, I would say there's some negative addition to the value strategy. That is, that they diverge from the strategy to some extent in a way that's a bit negative. It's still, they may do okay, but like their own personal decision making in it is a bit negative. Yeah. So even if you were to follow a spinoff strategy and say spinoff still worked, the little bit that they add to it tends to detract. But there's a few people, your Warren Buffett's and those, that what they add actually is very powerful. Peter Lynch, he's a good example of that kind of thing. He definitely would be someone that his addition to his feel for what things to buy and what not to buy and everything really added value. So when people say, let's just do statistically a Peter Lynch thing, I'd be very scared of that, because I don't think that really captures what he was about.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. If this is the first time you're joining us, be sure to hit the subscribe button and check out all of our work. Great way to do that is to go to focuscompounding.com to get access to investment write-ups from Geoff going all the way back to 2005, information on us, our money management services, and everything that we are doing with focused compounding capital management. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.